Adjusting the cost of capital.
Let's review that the cost of capital is the minimum rate of return that business must earn before generating value. This is a key element in the capital budgeting process. In a business process, projects should only be accepted if and only if their estimated returns exceed their cost of capital. Cost of capital is also known as hurdle rate. A project's rate of return must exceed or jump the hurdle to be accepted.
It means that riskier investments is equal to higher rate of return.
This introduces us to the connection of WACC, or weighted average cost of capital. Since WACC is only the weighted average, which means that it is the safest value of the cost of capital, it means that it is just right above the hurdle. To be able to jump the hurdle, the rate of return must be higher than the WACC to have a high cost of capital. It is not always that businesses will choose the riskier investment because it is always a gamble between all or nothing. So, there is also a chance in choosing investment that are least risky. WACC will be adjusted accordingly to high risk or low risk investments by the use of risk differential.
Please refer to the shown graphs on how to adjust the cost of capital depending on the WACC and the risk differential. Some other problems with cost of capital estimates. There are 5 problems with cost of capital estimates. 1. Depreciation generated funds. 2. Privately owned firms. 3. Measurement problems. 4. Costs of capital for projects of differing risk. And lastly, number 5. Capital structure weights. Number 1. Depreciation generated funds.
The largest single source of capital for many firms is depreciation, but the cost of capital is yet to be determined. Opportunity cost is the depreciation generated funds. It is approximately equal to the WACC from retained earnings, preferred stock, and debt. So, for us to prevent confusions, we can ignore it in the WACC estimate.
Number 2. Privately owned firms.
The previous discussion may have been about publicly owned corporations by public stockholders. How about those firms where stocks are not traded? Generally, the principle of cost of capital estimation apply to both privately held and publicly owned firms. What's different is just how to obtain the input data.
Number 3. Measurement problems.
Cost of equity is very difficult.
It is difficult to obtain the good input data in terms of G and risk premium in the formula RS equals bond yield plus risk premium.
As a result, the accuracy level can be very difficult to determine.
Number 4. Cost of capital for projects of differing risk.
Recall that different projects vary in their risk levels and as well as in their rate of return. The difficult part is to measure the project's risk.
Lastly, capital structure weights.
The target capital structure was used to calculate WACC. The target capital structure is a handful of tasks. Establishing target capital is very difficult.